All right, so first chapter, corporate finance, introduction. So our learning objectives are going to be defining the goal of finance, describing the relationship among investments, projects, and firms, and delineating the similarities and differences between corporate finance and personal finance. So what is finance all about? Basically, it's money allocation, right? So how does that work in business? How does that work from a personal perspective? And then from a personal perspective, how does that work if you're a Christian or perhaps if you're not, or how does that work? Um, so kind of the central tie to all these things is value. What do you value? How do we value these things? So the goal of finance, relative valuation, okay? We're going to make decisions based on value, okay? And you've got to know how to value objects. Um, so valuation, you need a good estimate. Can it be found, right? That kind of reminds me of Proverbs, just in terms of like, can a good person, good wife, husband, etc., be found? I don't know. Um, And then, interesting enough, the author, just note that the author is German. Okay, so a lot of the side remarks, jokes, etc., have that particular slant, that particular cultural undertones beneath it. So there's the joke for you. So one way that we could go about valuing something is with the law of one price. So note, this isn't a theory. This is a law. Okay, so it has been proven. And the law of one price says that two identical items should cost the same. So can you think of an example where this is true? Perhaps a counterexample where this may not be true, but maybe there's a caveat to it, right? So this is a pretty bold claim law. Note another definition here, opportunity costs. These are alternatives to the decision that you ultimately make, right? So you watching this video means that you had to decide not to do something else, or perhaps you're multitasking, hopefully not, but if you just doing this instead of doing something else, that's your opportunity cost. Um, Sometimes we'll approximate it, especially if goods are not identical. But generally speaking, it should be in relative range or ballpark. Um, the book, we will, for the majority of the semester, assume perfect markets, and then we'll talk about what happens when that breaks down. But a perfect market has no taxes, which we know is not realistic, but to make things easy, and then we'll make things more complicated, we'll first assume no taxes. We'll also assume no transaction costs. So no fees, nothing that would get nothing that would get in the way of us exchanging or doing business has a cost to it, either cash flow wise or otherwise. And then perhaps also technically no depreciation, but we know though that does occur. Okay. All right, so now looking at investments, projects, and firms. So some definitions here. So in this class, when we talk about a project, it's just a set of cash flows. Okay. Typically, your outflows are going to be your initial investment, any expenses, any costs. Anytime cash leaves your hand, that's an outflow. Anytime cash comes to you, that's going to be a cash inflow. So otherwise known as things like payoffs, revenues, or returns. So when we value something, we're going to have to take into consideration all the costs and all the benefits. That includes all the opportunity costs. And then from a benefit perspective, that could mean positive externalities, the author says pleasure, perhaps non-financial benefits, etc. All of that has to be included in, or should be included in, the valuation analysis. So a firm then, bringing all this together, is nothing other than a collection of projects. Okay. So a collection of a set of cash flows. So going back to our accounting equation, assets equals liabilities plus equity. Okay. So a firm is none other than how we finance it, the debt and the equity. as well as the inflows and outflows. So debt, that's another phrase for bond. This is a contract. It's a quote-unquote guaranteed financial claim. And if you don't guarantee it or it doesn't work out, that's breach of contract. You go to court or bankruptcy court, etc. And equity, this is a stock financial claim. You might get a dividend. You might get growth, but there's no guarantee of either one. Okay. Again, the firm is not just some of the projects, but it's also that the projects are inflows and outflows. So it's the sum of those inflows and outflows as well. Stocks and bonds are basically just inflows and outflows. So therefore, the firm is also just a collection of debt and equity. Okay. So some more formulas for you. The entire firm, it's all the outstanding stock plus all the outstanding liabilities. The entire firm is also equal to all net earnings, both current and future. And then the entire firm is therefore also equal to all current and future cash inflows as well as outflows. Okay. Another example or note here for you, bringing all these firms together, this debt and equity, these are markets that have to exist for the exchange of these things. So financial markets institutions, it's the fall 2024 finance elective, but the big one is the NYSE, the New York Stock Exchange. Okay, it's the big financial stock market. So now kind of bringing it all together. So, corporate finance, what this class is about, we're mostly going to be focusing on the supply of assets. You talked about assets in your accounting classes. Demand, what we did, in the spring, that was the investment perspective. That was the demand side of the house of the assets. So in this class, we're going to focus on supply, okay, mostly. Again, note assets equals liabilities plus stockholders' equity. And then the big question is, we're doing all this, how can we come alongside each other to make, hopefully, everyone better off, right? So, we've got people wanting cash. We talked about that last term in terms of investors and investments. Now, on the supply side of it, we've got money, and we're trying to figure out, all right, are we going to allocate it towards projects to help churn more money or do something else? Okay. And then how we bring all these together, that's financial markets and institutions. So in terms of corporate finance and personal finance, so kind of firms versus individuals, I would say probably firms and or individuals, kind of like a Venn diagram. But the decisions that are made, especially looking at it from a finance perspective, are both made very similarly between firms and individuals. And I'll let Dr. Trent speak more to what that looks like in personal finance. But a couple of notes and caveats here. So first, when we talk about value in the corporate context, we're talking about the quality of the market. Okay, so trying to take some emotion out of it, but doing an analysis and saying, all right, is it a quality market? Is it a quality project? Is this something we should engage in? Now, another note is that a lot of times there is going to exist a separation between the corporation and control, or another way to put it would be there's a separation between management and ownership. You do have owner managers, but most of the time, as an example, shareholders of companies, they are not also in the role of managing those companies. They hire out those managers. So there's a separation between the two. You don't control what you bought. So generally speaking, managers should do what owners want. What do owners want? Well, they want to maximize value. But this could lead into some ethical dilemmas. So example, does your product contribute to human flourishing? Should you even be in the business of what you're doing business for? How are the managers incentivized via compensation? Research has shown if you pay them with short-term incentives, they're going to have a short-term focus. If you pay them with long-term incentives, they're going to have a long-term focus. Okay, but that's something to consider. Do stockholders and bondholders want the same thing? Most of the time not. Bondholders are going to they just want to make sure they get paid. So they want lower risk projects. Stockholders, they might not get paid. So they're a little bit, they're risk averse, but they're not as risk averse. Okay. So they don't like risk, but they want to take on a little bit more risk than the bondholders do. Bondholders by contract have to get paid. Stockholders might not get paid anything. You could lose your entire investment. So they want to make as much money as possible. So they, generally speaking, want to engage in riskier projects. So now some conclusions. So generally speaking, you should make decisions based on value. We want to try to maximize value. The law of one price states that two identical items should cost the same. Generally speaking, you either pay an outflow, otherwise known as a price, to start a project, and then as a result of buying that project, holding that project, you receive inflows, otherwise known as revenues, after the project starts. Sometimes it could be vice versa, right? Sometimes you receive the money up front, and then you have to pay it back plus a return or interest over time. But that's generally how most normal projects go. You either buy the project, so cash leaves your hand, and then you receive the inflows of the project, or you receive a big influx of cash, and then you pay it out over time, back over time, plus some. Make sure you include opportunity cost and non-financial benefits in your analysis as best you can, okay, as best as you can value those things. Bonds or debt are contractual financial claims, whereas stocks, otherwise known as equity ownership, are financial claims in the hope of future returns through, hopefully, maybe, dividends and growth. Note, you want to buy low, sell high. That's how you're going to make your money. And then note, just as there is power in the blood and name of Jesus, accounting and economic knowledge, and even management to some degree, as I've discussed here, is power in the realm of finance. And I don't want to forget my marketing people too. Okay. So that concludes the lecture for Chapter 1. Chapter 1 is kind of short and sweet. I would strongly encourage you to read it. This particular chapter does not have homework like the other ones do, so try to engage in the end of chapter questions and questions throughout the text. The questions throughout the text have answers at the end. The end of chapter questions technically don't have those available to you, but I would encourage you to try to think through those as best you can. And yeah, we'll continue moving onward and upward with the Chapter 1 quiz on Friday. I would encourage you, especially during that class, after class or before, while we're in this weird in-between state, to try to talk to your colleagues, email your colleagues, discuss with your colleagues, etc., about choosing which company you want to do a financial analysis on. Note, you can go solo, but I would encourage you to try to work with a team. And then, it's early, but maybe even thinking through and looking at your other coursework for your finals and say, hey, a paper makes more sense, or hey, a presentation makes more sense, especially since this course, the final exam is going to be in that second, it's the second one up, so to speak, on that Monday of finals week. So a lot of things to think about. Pretty, light week in terms of our load, just one chapter here, so definitely take advantage of that. Consider your opportunity costs, benefits, etc., as was just discussed. And hopefully I will see you all on Friday, and if not, I will post the quiz password at that time. And hopefully I'll see you Friday or maybe next week, if not before.